Glad to stay with us. The recent downgrade of Dangote Industries by Fitch Ratings has sent shockwaves through the Nigerian business and financial landscape. With the conglomerate facing significant liquidity challenges and operational hurdles, concerns are mounting about the potential implications for the broader economy. I mean, it's not just about Dangote here. We're looking at the broader economy, seeing that some of the things that were mentioned are actually things you can find all around, especially when you look at the consumer goods sector. Now, in this interview, we'll delve into the details of the downgrade, its underlying causes, and the potential fallout for Dangote, Dangote Industries, and of course, I talk about the whole of the Nigerian financial landscape. Well, joining me for this, I have with me James Ola-Adisa, Investment Research Analyst with Chapel Hill Denham. Thank you so much, James, for joining me today.
Thank you very much for having me.
Great. Now, let's begin with this. What's your reading of the recent downgrade of Dangote Industries by Fitch? I mean, did you see it coming?
So when we look at Dangote Industries, the reality is I think everyone understood that the business was quite leveraged because of the need to build the oil refinery. So when we see this type of decision by the credit rating agency, I don't think it's one that should spook the market. It's just necessary for us to understand the risks that are involved in this business. I think that generally, when we look at their portfolio of companies, we see that the cash flow and the performance from some of their major businesses still remains strong. So indeed, it came as some sort of surprise, but and I think the idea is that the business is still very strong from our view.
Well, has the financial position of Dangote Industries actually gotten to an alarming point? I mean, does it seem to you like this rating is a bit too early? I mean, because you said it was a shock to you. So is it a bit too early?
So I think it's important for us to understand what the decision by Fitch was. And it's a rating watch, right? And it's typically event-driven, which means that when the event is resolved, we would then see a revision in the decision by the credit rating agency. And so I think that it's important for us to know that, this decision by Fitch to, sort of make the market aware of the upcoming obligation that they have is important. And it just keeps us abreast of the risk.
Oh, you didn't quite answer my question. I guess maybe you intentionally decided to evade it, right? Maybe we'll just move on.
No, go.
Okay, so I was asking you, do you think it was a bit too early?
Okay, so because it's event-driven, it comes when the risk becomes evident. So August 31st is close by, right? And so it's important for them to make the market aware of this risk. So it's not too early. I think it's right. It's timely. Let me put it that way. It's timely for them to, put out this note or this information about drivers of the rating decision. So it's not too early. I think it's timely, but I don't think it's a cause for alarm. That's what I'm trying to pass across.
Interesting. Now, given the current financial market conditions, which you and I are aware of, what options does Dangote Industries, have to ensure that it doesn't default on repayment?
I think they have a couple of options, right? First of all, they can restructure the loan. Restructuring is, given that it's a syndicated loan and it involves a lot of parties, might be cumbersome, but it's also an option that they can explore. There's also the fact that they can tap into the corporate Eurobond markets, which gives them long-term capital and will also give them competitive interest rates. I think that these are some of the immediate decisions that they can make, or some of the immediate options that they can explore in order to refinance and restructure this obligation that they have.
Well, what's the implication of this on the group, and how might this affect investor confidence? Because you're talking about other options that they have, that's maybe it's Eurobond and all of those. So, I mean, what's the implication this is going to have on them, and how will it even impact, their access to that market you just talked about?
I mean, the rating agency, downgraded some of their some specific things like national long-term rating and the senior unsecured debt rating, and this isn't a positive development for the business. So if the group, if there's a downgrade to the rating on the group, it tends to filter down to the subsidiary. And it just means that they'll have much more challenge accessing capital markets, and it might make their borrowing costs higher. But overall, I think that the impact would be muted for now until we see that they are not able to meet up with their obligations.
All right, I like how you talked about the group. Now, looking more specifically at the group, we know it cuts across various industries. You talk about consumer goods, talk about whether it's the industrial goods, or you also want to talk about the oil and gas and all of those. Now, talk to us, which of these are the major contributors to this, and what local or domestic headwinds can we blame for what is currently happening to the group?
Okay, so I think you can categorize the business into 5 major sectors. You look at the oil refinery business, they have the fertilizer business, sugar, NAFCON, and the cement business, right? And so when we look at the contribution to the group's revenue or EBITDA, I think as of the end of last year, cement was still the largest contributor, about 70%. But when we look at other businesses, like for instance, the fertilizer business, there's the idea that because they export, they're making a lot of export earnings from there, so it's hard currency effect. And it means that when converted to Naira at this prevailing exchange rate, it will definitely translate to a large amount of money and it's the most significant contribution to the group. So despite the fact that we still believe that cement still remains the largest portion or largest contribution to the group's revenue, we also see some of these businesses as very strong contributors, like fertilizer business.
Well, I'm also particular about, the part of the business that sort of contributed to what we are seeing now.
Okay, so the refining business. So we know that they've rolled out a couple of products. They haven't, started selling PMS in the domestic market, and they intend to start doing that by Q3. And so we see that the outlook is positive. There has been the dispute between the fiscal authorities, not dispute, but sort of the disagreement between them.
Or bickering.
They've agreed to begin to sell crude oil to the refinery in Naira. And so we think that that's a positive development. It means that the cash flows from that business will definitely improve. Now, the refinery is, a significant investment. 650,000 barrels per day is not a little. It's not a small, but when you look at the nominal capacity, it's significant. It's the largest in Africa and Europe, right? And so when this business begins to supply to the domestic market, begins to export this refined PMS product out of Nigeria, we will definitely see, improvement in cash flow. But as of now, they're just beginning the business. They're just starting. There might be some, rough patches here and there. And that has, cascaded into what we're seeing now with, an obligation set for the 31st of August. And we're now seeing that the business, might not have the liquidity to settle that.
Right. Still talking about...
According to Fitch, yeah.
Okay. Okay, interesting. Now, Fitch Ratings actually expect, gradual improvement in the EBITDA contribution from Dangote Oil Refining Company, just like you said, because we're expecting that to come on stream by third quarter of the year. I mean, we're already in the third quarter, aren't we? But away from that, do you see any risk to this? I know you've talked about how that's the federal government and, let's say, the regulator and the company have sort of tried to address this. We're talking about selling crude in Naira and all of those things. But beyond that, are there other risks you see to, eventually taking off and producing maximally? Because we also know that the refinery's operation is at 50% capacity.
Yeah, so I think one of the risk that is a bit evident to everyone is the crude oil supply. That has been a challenge for the business, since we started. And, it's important to mention at this point that there are now news flows saying that, we're producing about 1.6 million barrels per day. And this means that that risk is more or less going to be mitigated in some way, because if we improve our production as a country, it would mean that we'll naturally be able to supply much more crude oil to Dangote refineries. So that's one of the major risks that I see to a smooth takeoff of the business. Aside that, the fact that he's going to be exporting, supply chain disruptions also naturally might affect the business in some way. But those are the two major risks that I see to a smooth take-up for the business.
All right, so beyond Dangote, we have seen many results from the consumer goods sector, and we also sort of see the impact of currency depreciation on earnings. So what's more scary is even Fitch projection that devaluation would continue at a higher pace in 2024. I mean, this is clearly beyond the companies. How can companies mitigate these risks? And before then, I'd like to know if you also agree with Fitch on that.
You know, about the currency devaluation,
yes.
Right? So I think we've seen huge swings in 2024. The currency has depreciated to, about 1,800 level this year, and we've also seen it appreciate to about 1,200. And I think what is important now is, stability in the FX market, not necessarily where the rates settle at the end of the day. The willing buyer, willing seller market. So the forces of demand and supply will naturally, at some point, even out. We see pressure and it will translate to depreciation of the currency if there's limited supply. And so we naturally need to fix the supply leg of our FX market. So to answer the question, I would say that, depending on how the outlook for liquidity is for the country, and I think it's a bit positive, because if we look at the improvement in crude oil production, it means that export earnings would improve. We've also seen foreign investors coming into our market at some point this year, and this does not, our interest rates are still elevated, so there is also room for much more foreign flows into our market. So liquidity could possibly improve, and the fact that we're also selling to the Dangote in Naira, has indicated that there might be some form of FX savings from that. So we would expect that with this inflows and this liquidity in the market, we would see some form of stability. I mean, the currency hasn't had such huge devaluations like we saw in depreciation, rather, like we saw in Q1 of this year. We've seen it depreciate consistently, but at a slower pace. So yes, I agree that we might possibly see some more depreciation in the Naira, but this is for as long as supply remains limited. Once we start seeing an improvement in liquidity in the market, once supply improves, we will begin to see the currency stabilize. And so, tying this to the next question you asked for the consumer goods needs, I think that, they have significant FX exposures through their debt and through the fact that they, import a lot of the raw materials that they use. Some of their cost items are FX denominated. And so for these businesses to hedge against this FX risk, they need to begin to look inward to see how they can substitute some of these things that they import into the country with local materials. And if they're able to do that, naturally they would reduce their demand or their need for FX. So I think that would be one of the good ways that consumer goods companies can also hedge against FX risk. Secondly, there's also the fact that they can restructure their debt. So if you have significant FX exposures in your books, you can convert that, bite the bullet now, convert the dollar debt into Naira debt, and then begin to pay Naira. So there isn't the mismatch between your revenue coming in local currency and your debt being in US denominated. Those are two ways that I think consumer goods companies can definitely help reduce the foreign exchange risk.
Well, doesn't debt restructuring come with its own risks?
You mean restructuring the debt from?
Yeah, debt restructuring. Doesn't it come with its own risks?
Yes, it does come with its own risk. But when you look at the outlook long term, do you want for business to have a mismatch between the leverage you have? So you have dollar denominated debt, and then you're earning revenue in Naira. And then at any point in time when we have a massive devaluation of the currency, you see your business reporting losses. Or you buy the bullets now, and you then know that moving forward, you don't have an exposure to significant FX risk. I think that despite when you look at the opportunity cost of keeping this dollar debt on their books, to me, I would say, restructuring it to Naira denominated debt, would be the benefits will far outweigh losses.
All right, so talk to us about your outlook for consumer goods companies in Nigeria at the moment.
So for the consumer goods sector, I would say the outlook is somewhat weak. And I say that because with the massive devaluation in the currency, we've seen it erode significantly consumers' purchasing power, right? And the currency is still not stable. There's still volatility in the currency. Now, in addition to that, we've also seen them increase minimum wage. But the reality is that they haven't increased, or we haven't seen an increase in minimum wage to the tune of inflation. What I mean is inflation is moving faster than the increase in minimum wage. And so that means that there has been some erosion of value in investors, what the disposable income that consumers have. And so that naturally doesn't bode well for the consumer goods sector because, how are they then able to pass on this cost to the consumers that are barely making ends meet. So I think the outlook is a bit bleak for the consumer goods sector.
Right. Thank you so much, James Ola-Adisa, Investment Research Analyst, Chapel Hill Denham. Thank you for your time and your thoughts.
Thank you.